of them have now argued that we're very close to neutral, we're close to R-star. So for that reason, there is really no reason for them to move rates in any way or signal anything dramatic at this point.
You were weaned in the continent on the politics of central bank policy, the experiment of the ECB. I mentioned the frenzy in a light way during the snooze fest, but what we've seen, the disruption since John and Davos, with the second lesson, the disruption that we've seen for the last week, and particularly yesterday with the dollar, how does that change this moment for Powell?
Well, the dollar going down, of course, is potentially something that has some upside risk to inflation. But at this point, he may be asked about this today, but my best guess is that he will say this is still very early, and so from a pure inflation perspective. Remember also that the US is a closed economy, exports only 10% of GDP. So from that perspective, the dollar matters actually less for the US inflation relative to how much the euro matters for inflation in the euro area.
TK, I think we've got to get to the elephant in the room, and that's Torsten's big call for the year ahead. Do you think that Wall Street is underplaying just how hot GDP could be in the next few quarters?
Well, if you do go into your Bloomberg screen and look at the consensus expectations to growth, it tells you that growth 18 months to literally be 2.0. That happens to be exactly the potential growth rate from the Congressional Budget Office. In other words, there is not much drama to the upside expected. There's not much drama to the downside. But if you begin to look at what happened on January the 1st with the one big beautiful bill being a tailwind, we still have AI and data center build out, that's a tailwind. We now also have the dollar going down, that's also a tailwind. And we also have oil prices going down, that's also a tailwind. So the risks are indeed beginning to rise, that we're going to see growth accelerate as we go through this year. So I do think that it is maybe laziness on the forecasting community, but at least it looks like from the forecast that people are just penciling in 2.0, meaning the long run growth rate.
Let me follow up, because I don't want to lose friends this afternoon either, but is Wall Street getting intellectually lazy, or are they just struggling to price the chaos?
Well, I do think that it's, of course, a struggle to figure out both, of course, what policy last week or so, also some pretty significant changes on the geopolitical front. So it is still very uncertain in terms of what are the implications when it comes to what's coming with tariffs. Is more coming? What's coming with tariff uncertainty? Are companies going to pull back because there's more uncertainty? But all that aside, I mean, it still is the case that if you take fiscal policy very expansionary, now you have the dollar going down, you have oil prices going down, and you still have a strong AI boom with a data center and energy build out. Those are all very strong tailwinds, not only to CapEx, of course, on its own business fixed investment, but also to consumer spending. So I would expect that growth is going to be higher than what the consensus is expecting.